get a survey at the end of the day, so please fill it out to get your credit. And with that, I will introduce Dan Rahill. He is the Managing Director of Wintrust Wealth Services, serving as a resource for financial advisors to understand their clients' financial objectives, determining strategies for complex financial and wealth issues for high net worth clients and family offices. Dan frequently lectures to CPA societies, bar associations, family office organizations, trade and industry groups, and colleges and universities. He is published and quoted widely in the media, industry, and accounting publications such as the Chicago Tribune, Crane's Chicago Business, ABC 7 News, Yahoo Finance, and the Illinois CPA Society's Insight magazine. Previously, Dan was with KPMG for 27 years and held numerous leadership roles, including tax managing partner of the Chicago Metro Business Unit and Midwest leader of the mid-market practice. Dan was also a trustee of the KPMG Foundation and served as the global lead partner on many of KPMG's high-profile multinational accounts, privately held companies, and family offices. And if that didn't impress you enough, prior to KPMG, Dan practiced law in Chicago, specializing in tax and estate planning. He began his career in audit with Ernst & Young. And without further ado, Dan Rahill, take it away.
Thank you. Thank you so much. Can everybody see me and hear me okay? I take that as a yes. Okay, thank you. Welcome everybody. I won't repeat what was just said. That was quite a lead-in. I appreciate it. Unlike most of you, I'm a little bit different. I spent 40 years of my career in public accounting, in the Big Four public accounting. In the last several years, I've made a pivot to financial planning, personal financial planning, and studying for my CFP, which I think all of you probably already have. So I'm way behind all of you, but my background has been in financial planning for high net worth individuals and family offices for the most part, including closely held corporations that families tend to own, and that's how they created their generational wealth. This morning, I actually have made a few adjustments to this PowerPoint as of 9 a.m. this morning. There are two bills in Congress. If you've taken a look at your Wall Street this morning or any other news outlets, you'll see that Nancy Pelosi is positioning these two bills for a vote, both the infrastructure bill and what I call the social infrastructure bill, due today. As of 8:30 this morning, the Republican group of conservatives within the House have delayed procedurally, but they won't be able to delay it forever, the votes. And I will, please stick around to the end because I've got some predictions for you as to what's going to happen today and through the end of the year. So let's go back to September 13th and the first iteration of the House plan. It was $3.5 trillion, and as we moved through three different iterations, October 28th, it was scaled back in half before the president went over to Scotland for the climate summit, and they scaled it back to $1.75 trillion, which also has received some resistance from both sides in the House and the Senate, from moderates and such as Kristen Sinema from Arizona and Senator Joe Manchin from West Virginia. So there's been a third rewrite that happened this week, just 2 days ago, and that has positioned it for voting today. And it certainly appears that Nancy Pelosi is very motivated to get that to happen. So let's move on. It's called the Build Back Better Act, which is the title of my presentation. And although that is also morphing now too, there's only 2 B's in it as of this week instead of 3, but you'll see me refer to the BBBA as the act. So let's move on a little bit to some notable updates in the last week. International tax changes have remained in the package as other things have been dropped as of last week. This is where most of the revenue is coming from. I will not be covering those today. They're not really relevant to this audience, but just to know where the money is coming from, and I'll show that to you in a second. It's mostly from the international and corporate changes. And then while in reaction to Senator Kristen Simina's objections to rate increases on both corporations and individuals, the framework, and let's call the second iteration the framework, has increased the surcharge on high-income individuals, and I'll show that to you as we go through the changes. Here are just some noteworthy quotes that have come out in the last few days. The fact that this is after the framework was issued, Senator Ron Wyden, Finance Committee Chairman, said this is not done, there's more work to do. And he was right. There have been some changes in the last 24 hours, and there will continue to be some changes. I'll try and predict those as best I can. The billionaire's tax was originally omitted from the September 27th bill, but that has been, if you will, reproposed. It's not in the current iteration, but beware of Senator Ron Wyden when it gets to the Senate. He really wants that billionaire's tax to be added back, but it's currently not in the House version. Chairman Neal, chairman of the Ways and Means Committee, has talked about some skepticism on the current proposals, but that was as of 4 days ago, and apparently he is on board now, and we'll vote on that today. And family leave becomes a very big issue, and it's not going to directly impact the revenue of most of our clients, but some. And it will be met by opposition once it gets to the Senate, specifically from Senator Joe Manchin. And finally, this morning, there was another change to the salt cap proposal. So I'll talk about that in a little bit. While Manchin originally signaled his support for the package on October 27th, when the framework was presented, on Monday, just this past Monday, Manchin came out and said he's not yet on board with the social spending proposals. You can see a couple of quotes there, so remains to be seen. On Wednesday, the third iteration, which we'll call the manager's amendment, came in, and it did have some significant changes to several sections, which I've added to this PowerPoint. So stay tuned. This is not the end of changes, and we'll talk at the end about what the next steps are. This is my change this morning, and you can see on November 5th, which is today, the salt cap was raised in the House proposal in the manager's mock-up to $80,000 instead of $72,500. And if you've paid any attention to what's been going on in the news, Senator Bernie Sanders strongly objects to this. Of course, he's over on the Senate side, so he can't control what the House is presenting. But he does not want any state and local tax breaks for anyone making over $400,000 or $500,000 a year. So we'll see continuing changes to this proposal. So stay tuned. This is not set in stone yet, but strategically, what Nancy Pelosi has done here is she's left salt out of the proposal until the very last moment, which is now. She's now pulled the trigger. It's brought back in, and it's into in the debate. So we'll see more changes to that. And retirement account changes. Those were in the original House proposal. They were dropped, and now they're added back. So I have an entire section on that. I've left everything in from our October House presentation, or our House proposals, because things are going in and out almost daily, and we'll talk about that. So let's go over the agenda for today. I want to go over the individual income tax proposals, and you can see them here on the screen. I'll go over each one of these in a separate slide. The individual retirement accounts, huge changes in this area, as you'll see. And they've been in and out, and now they're coming back. Some of them, most of them are coming back into the proposal from the framework. So I'll go over that. And then estate planning proposals, the step up in basis remains. We were very worried about that early on. And then I will go back into some corporate tax changes. And again, Most of the revenue is generated here, but I won't be going into those in detail today, but I will discuss three that should affect closely held corporations and family offices. And then I'll conclude with what's not in here, but I want to stress that any one of these items that I go over at the end that's not in the current proposal, that's hopefully perhaps being voted on today, could come back. So I want to leave an inventory with you of those so you're not surprised if they are resurrected on the Senate side, and then the November outlook. So a little bit about the revenue, and you can see where the markup tax increases. Originally, we were going to raise the rates on individuals, high-income individuals. That was going to be $1 trillion. Most of that had to be replaced when it was dropped in the framework. And you can see the retirement plan modification rules, $4.3 billion. Again, not a big number, but they've been in and out. International and corporate reforms, almost $1 trillion there in other provisions. So that adds up to about your $2 trillion. And here's the breakdown of the bill as it stood a week ago. About $2 trillion. And you can see the 15% corporate minimum tax came back in. Corporate reform, stock buybacks was added late. And then there are some individual changes in here. $400,000 from the IRS, investments in the IRS to close the tax gap. That's a very loose number in my mind. I don't know really how they come up with a number like that. But be that as may, that's the $2 trillion of revenue that is going to be raised by this bill. Let's just jump into the details here. In the original House bill, you'll recall these changes: 37% to 39.6% for married individuals filing jointly over $450,000. Again, raising the top marginal rate, effective for years beginning next year. So for approximately 5 weeks, we are going out and talking to our clients about income tax, what I call bracket management, which is moving income and deductions from one year to the next and vice versa, to take advantage of the fact that this year is going to be a lower rate than next year. But then along about 10 days ago, Senator Sinema came out and said, no, I'm not going to support any of these bracket increases. And that's where the framework deal removed this provision. So this is not in here right now. Nancy Pelosi reacted to what the Senate and Sinema had presented, and it's now out. The reason I leave this in here is any of these changes could come back in, as you'll see, certainly in the retirement plan section. This is not set in stone, but this is what's going to be voted on most likely today, later today. Top capital gains increase. Again, we talked to our clients about the fact that this gains increase is going to be retroactive to September 13th, 2021. I had one client sell his company for $98 million. We thought that this date was going to be September 15th, 2021, based on Nancy Pelosi's announcement back in August that she wanted drafts of committee language on September 15th. Lo and behold, they're also aware of how we react in our world, so they moved it up 2 days, and my client actually on September 13th was shocked to find out that they couldn't close their $98 million deal and get the lower capital gains tax rate. Well, as we move forward to last week, the framework deal as of October 28th took this back out. And so there's no longer in the House bill an increase in capital gains as of last week in reaction to Sinema's objections. So stay tuned. I spent a lot of time talking to people about what's on this slide, and now I don't need to anymore, but we shall see what happens in the future. The tax surcharge for high earners, this has changed, and this remains, and it remains even more fervent towards taxing high-income individuals. Originally, if you recall, going back to the original House bill, it was a 3% surcharge on taxpayers' MAGI, so basically adjusted gross income with a few changes to it, and that's been in the code for a number of years, that definition, in excess of $5 million. And you can see it here. The sticking point here is that for trusts and estates, it's as low as $100,000. So if you've got a complex trust or an estate it's going to hit them very, very soon, and causing a lot of estate planning attorneys and people like myself to look at different trust structures to see if we want to keep those in place. These changes would have applied to next year, so 2022. However, in the framework on October 28th, last week, this was adjusted upward. Remember, we just took out the increase in tax rates for individuals, as you saw. But how are we going to replace some of that income? Well, they increased the surcharge too, but they increased the thresholds as well. Those making over $10 million, it's going to be a 5% surcharge, and those making over $25 million is going to be additional 3%. So it's an 8% surcharge on those making more than $25 million. But you can see really where it's going to affect many of you that are watching right now. Again, complex trusts and estates are going to be hit at a much lower level. The 3.8% net income tax, or NII tax, as we've called it for many years, that exists on capital gains, interest, and dividends. So basically, net investment income today on your tax return. You'll see it come in on a separate schedule on your tax return for that income above a certain level. $200,000 married filing jointly. Well, the House proposal expanded this tax to apply if you're making over $500,000 as a joint filer to everyone. One of the great plays that we've used, and I've used it for over 35 years now, is to have an S corporation that throws out its income as a non-taxable dividend because it's previously taxed income, and we can avoid the 3.8% net investment income tax and FICA tax on S corp earnings. That's being taken away. It's been out there for years. We've known about it. The Iras has known about it. They've enacted rules, a revenue ruling in the 1990s that said you have to take out reasonable compensation subject to FICA. This is all interrelated with the NII tax. Now there's going to be a 3.8% tax above a certain level on everything. And this further adds to the top marginal bracket for high net worth individuals, which you'll see at the bottom of this slide. But before I get to the bottom of the slide, what I just talked about is the 3.8% is an NII tax on investment income, but it's also the same number as your FICA Medicare tax that bolts on top of FICA, right? So now that 3.8%, it's merged and it applies to everyone. And the top bracket after this year will now be, and I've got it at the bottom, 37%, not 39.6 now, that's come down to 37, but the surtax for those making over $25 million is now 8%, and the 3.8% NII tax is now 3.8. So you're now talking, before state and local income taxes, a 48.8% bracket for the very high net worth individuals, high income individuals. This one has been, we're waiting to see on what happens in the Senate right now on the 20% deduction for pass-through entities. As you recall, when the Tax Cuts and Jobs Act was enacted at the end of 2017, effective 1/1/2018, that allowed for or provided a 20% deduction for pass-through entities to bring the income tax rate down from 37 to 29.6%. 29.6 for individuals with pass-through income is exactly 80% of 37%. And this was to equalize the brackets with respect to corporate taxes, which on C Corps went from 35 to 21. So this was a fairness provision that came in effective 1/1/2018. And it's been discussed as, well, if individual rates go up, we need to adjust this to go up as well, right? This remains in the code right now, and as far as the markup is concerned, it would have been capped before at $2.5 million under that proposal, and it was not included in the framework deal. Now, I'm going to not spend a lot of time on how they changed this in the original House proposal because it's out right now. But be prepared to see perhaps, once it goes to the Senate, this coming back, that there might be a limitation on the 199A deduction. Excess business loss deduction. I have only seen this once since it was enacted in the 2017 Act and the Tax Cuts and Jobs Act, where an individual gets a K-1 with a $500,000 or more loss on it passing through, a pass-through loss of $500,000 or more. Obviously applies to high net worth individuals that invested in startups. This proposal would modify that, and it was scheduled to expire after 2025. It's now being permanently extended and changed in a way such that the carry forward losses don't roll into a net operating loss. They stay in their own little compartment of disallowed losses for this provision. Again, it gets somewhat technical, but it adds another layer of restriction on how to use losses if you have a loss from a pass-through entity. Wash sale expansion. I just want to talk about, and many of you are aware of this strategy with regard to trading in cryptocurrencies and other types of investments. They're not subject to the 30-day wash sale rules, right? Those only apply to publicly traded securities. So a common investment strategy has been many cryptocurrency changers, because of the volatility. When it drops, they'll sell their currency and buy back in, thus locking in a loss at year end, which then they can deduct on Schedule D. They'll lock in their capital loss and move forward with the position at a lower tax price. And it just is a maneuver. They're selling it 1 minute and buying it back the next and generating a tax loss. So this was noticed. And the House bill sought to disallow this strategy by cryptocurrency traders and other similar non-financial assets, if you want to call those non-financial assets, and not traditional financial assets. And that was to apply after 2021. The framework that came out last week was silent on this, but other provisions within the framework allude to the fact that this is still in there. And so in my mind, this remains a restriction. The 30-day wash sale rules will apply to cryptocurrency trading. Carried interest. This is interesting in that it was removed in the framework deal last week. This has been a platform position of the Democratic Party going back to the Biden campaign, as to limit carried interest, and going back to Hillary Clinton's campaign. It's been around for a long time because this benefits high income individuals, specifically hedge fund and private equity. The original proposal, the House proposal that came out in September, proposed to increase the holding period to get long-term capital gain for hedge fund investment on their carry from 3 to 5 years. However, this was dropped, and it's very curious that it was dropped. Obviously, this lobbying group has a lot of influence in Washington, and we would call it Wall Street and other high income traders. And so this is out right now, but this potentially could come back in on the Senate side. Let's talk about some massive changes in IRAs and retirement plan proposals for a minute, and how these are going in and out and could continue to change down the road. Limitations on contributions to large IRAs. The original House proposal prohibited contributions either to a traditional IRA or a Roth, or defined contribution plans if your accounts exceed $10 million. Now, I've got a client that we're actually helping right now redo his estate plan. He's 72. He's starting to receive Rmds. He's got a $25 million IRA. How do you get a $25 million IRA? Well, if you're Richard Thiel, you'll put PayPal stock into a Roth IRA in 1998 and watch it grow. But this individual had a company, a family-held company, that he sold to an ESOP. And as you know, an ESOP is a qualified plan, and that when he retired, he rolled that now $25 million into an IRA. So this would affect that individual, as will many of the changes that I'm going to talk about in a minute. No longer be able to contribute to that IRA. Now at age 72, he's not a candidate for contributing. He's actually starting to take his RMDs. But for anyone else, there are a lot of individuals that have done similar transactions over the years, business transactions, ESOPs being a classic example, where they have over $10 million IRAs. So this would prohibit contributions to those IRAs, but it only applies to people above the Biden definition of high income, which is $450,000 for married filing jointly. And it applies to years beginning after December 31, 2021, when this came out, back September 13th. Again, we always encourage our clients to maximize their retirement contributions, but we really focused on this. Well, now it was taken out of the framework deal. But what happened, and that, the framework deal, recall, is the second iteration of this bill. The original bill came out, it was 2,500 pages long. The framework deal, which came out on October 28th, I have the date here at the bottom of the slide, that pared it down to about 1,600 pages. But yesterday, as I was going through the November 3rd updated version, let's just call that the manager's update, the committee that did the final framework review updated this, and it added this section back. So it was in the first iteration, September 13th. It was removed on October 28th and put back in November 3rd, which was 2 days ago. So stay tuned for further changes on large IRAs, and you'll see this in the next few slides on other sections as well. So don't lose these slides, because these slides or variations of these slides could be handy down the road between now and December 31st. Required Rmds for large IRA account owners. Again, this was in, it was out, and now it's back in. And what this provision says, and by the way, I had to find the effective dates, this happened so recently, just over 24 hours ago. I had to go into the detail, which was very painful for me, because it was on page, I finally found these effective dates on page, I think it was 1965. And reading the detail of the proposed law took some time to decipher, but I've done it for you here, and this is back in. So what you need to do for your large RMDs, and it doesn't matter your age. You don't have to be age 72 anymore, or be required at age 72 to have an RMD or have an inherited RMD if you're under age 72. If you have a large IRA, 50% of the excess over 10 million is required to be distributed. So my situation with my client that has 25 million, this would apply to him. So instead of getting about $1.1 million per year, which I've already calculated for him at age 72, he would have to take out this year. If this were in place, starting in 2022, he'd have to take out the excess of 10 million, 50% of the excess over $10 million, or the entire account balance exceeding $20 million, but limited to the lesser of the aggregate balance in excess of $20 million, or all of the balances in the Roth accounts. So figure that one out. So, we're going to have to if it gets enacted into law, it's going to be, again, added one more layer of complexity to all individuals, not just those over age 72 with large IRAs, in computing a significant RMD for them. And again, currently that's in the House bill. Income limits on Roth conversions. Look at the date on this one. I published an article for Wintrust Wealth Management, my employer, and I had in there this date. And it went through editing and compliance review, and they changed it to 2021, figuring, gosh, Dan must be wrong. It has to be 2021. No, I was not wrong. I caught it and I had to move it back to 2031. That is not a typo. So Roth conversions, so if you're currently converting, which I personally do, and I'm doing it, I call it a leaking Roth conversion over time to try and do some bracket management. Converting IRAs from regular IRAs to Roth IRAs over time for married filing jointly taxpayers over $450,000, you would no longer be able to do a Roth conversion in after 2023. So that's so far down the road. Your guess is as good as mine whether this provision will last the next 10 years, but it's not included, was not included in the framework October 28th and then added back in. So it's currently in there. Backdoor Roth conversions, gone. All right. And I've consulted with people on several of these, many of these. And the backdoor Roths, as you know, you can put, let's say you put a $7,000 contribution as a non-deductible IRA contribution. So non-deductible, so it's sitting in a regular IRA, and at the end of the year, you convert it to a Roth. Because you never deduct it in the first place, you don't have to pick up the income on the Roth conversion in the second place, and now you've converted a non-deductible IRA into a Roth. This would go away as of December 31st, 2021. I have several people that regularly do this every year, and I'm telling them, okay, this could be your last bite at the apple to make a contribution on a backdoor Roth. A limitation on IRA investments. So currently, if your client is the owner of an entity and he's got a self-directed Roth with entity stock in there, entity equity in it, and it's over 50%, that's a prohibited investment. You can't do that. So that 50% threshold under this provision has been decreased to 10% for any non-publicly traded entity. And it expands it to any investment if you're an officer director of that corporation, of that private company. So this is a further tightening on IRA investments. Again, probably directed towards the political report that came out late in the summer on Richard Thiel and his $4 trillion Roth IRA that got such bad publicity, and the fact that he followed the rules to the letter, but the fact that it got so big angered many in Washington, and they are seeking to shut that down. So it includes a 2-year transition period if you are in that 50% down to 10% range of ownership, that you can address this and get that stock holding or partnership holding out of there. This is one near and dear to my heart because I have a few of these investments personally where I have a self-directed IRA and I have some angel investment, startup company investments in there. And of course, to do that, you need to be an accredited investor. And you'll see 3 definitions here of an accredited investor and what the House of Representatives thinks an accredited investor is. And if you have those investments in your self-directed IRA, you have 2 years to move them out. And it's effective for 2 months from now. January 2022 is when this would occur. And wisely so, on October 28th, the framework drafters removed this provision, but yet it got added back in the manager's write-up, in the manager's markup, let's call it, on Wednesday. So stay tuned on that one. Is this an area of abuse that greatly benefits high net worth individuals? I don't think so, but it's in there currently. So we'll see what happens with this one. Statute of limitations has been expanded to 6 years for IRA noncompliance. That's not included in the October 28th, but was added back, as is the one at the bottom here, disqualified persons definition. All right. We've got, I want to shout out right now, are there any questions that you want to ask so far on either bracket management or IRAs? If not, I'll jump into estate and gift.
Hey Dan, I am seeing a couple of questions here.
Okay.
So the first question is, what kind of complex trust would get hit with the $200,000 modified gross income?
Okay, so stated simply in layman's terms, a non-grantor trust or a non-simple trust. A simple trust or a grantor trust, the beneficiary of the trust gets a K1 at the end of the year. It passes through the income, and it shows up on their tax return. A complex trust pays tax, or an estate pays tax on its own. So it would apply to those types of trusts. So again, non-grantor complex trusts, not a simple trust. So that's who it would apply to.
Thank you. And then the next question is, are mega backdoor Roth IRA conversions on the chopping block?
Yes. The mega Roth 401k conversions would be caught up in those bills right now. And Wall Street Journal had a great article on it about 2 months ago. Many of you probably read that article and remember the backdoor. My son, who worked at a company that starts with a big G and has an internet search engine, they had that program, and I read his 50-page write-up on it, and I thought, this is great. I read it during the summer. They could do backdoor 401k Roth conversions. Well, that's all going to go away under these proposals. So.
Gotcha. There is one more comment here. Sounds like there's concern about a number of clients that are in the middle of backdoor Roth IRA conversions. Sounds like if they could convert their last portion of the non-deductible IRA in 2022. So I guess it's a question around clarity of like when would the law be in effect for
January 1, 2022. So if you've got a client in the middle of doing one right now, get it done. Get it done. You're grandfathered. You're okay right now if this provision survives. So the effective date would be January 1.
Understood. And
okay.
One more question came through, Dan. Question is, if an IRA owner has alternative investments that require the owner to be an accredited investor or qualified purchaser, will those alternative investments potentially need to be pulled from the IRA if that stipulation you mentioned goes through, or is there a proposed grandfathering aspect to that?
No grandfathering. They got to be pulled out of the IRA, but you have a 2-year transition period. Now, they haven't explained how they expect you to do that. But one guess is that you would, on a tax-free basis, over 2 years, do a swap. So you'd swap other assets into that IRA and remove, for example, the private equity investment that you had, or a startup that you need to be an accredited investor for. So you'll have a 2-year transition to pull it out, but you will have to pull it out. There's no grandfathering currently in the law.
Good feedback there, and we continue getting a few questions coming in. Just one more. Do you have an idea of when we might know, especially with respect to the Roth, no more backdoor Roth? I think that's a strategy that many of us utilize. Mm-hmm. Any ideas on when we'll know for sure what's going to happen?
I think it's going to be late December or any time between now and then. I go back to the Tax Cuts and Jobs Act that some call it the Trump proposal of 2017. That was passed on December 21st. This one is going to go right down to the wire. This will some people think it might go through by Thanksgiving. I don't think so. I don't think so. I think you're going to be right at the end of the year before we know whether these retirement plan changes and other changes are going to be included or not, because once it gets to the Senate, if it passes the House today, so there are scheduled to be 2 votes today. One is on infrastructure. If that passes, it goes to the president and it's signed into law. Done. And people in Washington on both sides want to get that done, including the Republicans in the Senate that voted for the Bipartisan Infrastructure Act. What is going on with the Build Back Better proposals will, if that's passed today, and if they can line up all the Democrats in the House, and they don't lose 3, if they're able to get everybody on board today on that vote, then that goes back to the Senate. And the Senate now has their markup. So we don't know. We won't know till the Senate's done. And then once the Senate's done, it has to go back to the House for a vote. And then the House has to agree on it, and then it goes to the president for signature. All that's going to take time. It's going to take weeks and weeks and weeks. So stay tuned as to whether that whole that timeline holds. So.
Thanks, Dan. That's all the questions that we have for now.
All right, thank you. Let's go over some estate and gift tax proposals, which perhaps, depending on who your client is, these are the biggest proposals and the easiest to understand for clients with respect to the law changes and the proposed law changes. Originally, this summer, the Biden administration went down a certain road, and now I look back at it thinking, how strategic was this? They left in place the fact that the estate and gift tax lifetime exemption, currently $11.7 million, would not be adjusted until it reverts back to one half of that in 2026. Okay, so they didn't touch it all the way through until we get to September 13th. And then September 13th, when the first House committee proposal was issued, now they brought back the reduction from 11.7 down to approximately $6 million in 2022. So they cut it in half. All they've done is accelerated by 4 years the reduction. And this is something that is the first thing I talk about when I'm talking to a high net worth individual is make sure you get this done because it's going to go away anyway in 2026. And it very well could go away in 2022. And I'm sure all of you have said the same thing to your clients. Well, it didn't come back in until the House proposal in September. And once we get to the framework on October 28th, just last week, it gets dropped. It gets dropped. So we shall see. Now, it's still going to expire in 2026. Again, this is a timing issue of when the 11.7 million reverts back to one half of that indexed for inflation. And right now it's not in the bill, but I leave this here because as all the prior slides, this could come back and you're going to continue to see this discussed along with the billionaires tax, which is a favorite of Senator Ron Wyden, who's chairman of the Senate Finance Committee. So stay tuned on the lifetime exemption. Grantor trust rule changes, again, created a lot of angst over the last 6 weeks for all of you. If you've got a client with a slat or an islet, we've been rushing to get those done. We've been rushing to pre-fund our irrevocable life insurance trusts, our islet, so that we no longer interact with those grantor trusts, which would blow grantor trust status. And estate planning attorneys have been strategizing hard on how each one of these trusts for their clients are going to be affected, right? The House proposal would severely limit the ability to use grantor trusts. So it's not a direct attack on islets or slats. It's an indirect attack on basic planning and strategies that we estate planners have been using for decades. And we went through this and as recently as 2 days before October 28th, I met with a high net worth family that owns a 9-figure family business, third generation, is thinking about selling, and they want to do estate planning, and they want to take advantage of the 11.7 million before the end of 2021. And I walked through all of this, and guess what? 2 days later, all of these proposals have changed, including these grantor trust rule changes. So again, stay tuned. Keep an eye out for this as to whether any of these come back in the Senate. If this bill passes today and it goes over to the Senate, it remains to be seen. People think it's more likely than not, and perhaps a should level of opinion as to whether these two bills will get passed today or this weekend. That's as high a percentage as I've seen on handicapping the chance of these bills passing. But again, this has to now go to the Senate, and they're going to take out their red pen and start rewriting these provisions. So none of us can really sit back and take it easy because we could only have days before January 1, 2022 to act. And by the way, that's also by design in the background. Legislators don't want you to be able to plan for these things. That's why you have had effective date of September 13th on capital gains changes. They didn't want we planners, to plan around the capital gains increase. So that's why things are, the date that a bill gets entered into is sometimes the effective date. Another huge one for you planners out there, the valuation and valuation discounts, marketability discounts, minority interest discounts on the transfer of closely held businesses to dynasty trusts, gift trusts, family limited partnerships. We typically take a 30 to 35% discount on the transfer of a minority interest in a partnership to in a gift trust. That was going to go away after the day that the act was signed into law. So if President Biden were to sign this into law on December 1st, that would be the effective date. It wasn't going to be January. It was going to be whatever day that the president signed it into law. But guess what? And so again, I was talking to many families about doing these transfers up until October 28th. When I said, time out, forget everything I just told you, but don't forget it totally. But forget everything I just told you up until October 28th, because this is no longer in the bill. So as of today, we can still take valuation discounts in estate planning for transfers of marketability discounts and minority interests. So that's it from the estate and gift tax planning side. There are a lot of proposals. I have a slide at the end in a few minutes. I know we only have about 13 minutes left. I have a slide in the end of other things that aren't in here that could come back in. Corporate tax rates, guess what? This was taken out. Thank you, Senator Kristen Sinema. What this would have done if we raised the corporate tax rate to 26.5% under the original proposal, it would have made the United States tax structure one of the highest in the world. Right now in the OECD countries, we're about middle of the pack at 21%. When you add to that our state and local effective tax rate. So add to that another 6 or 7%. We're currently at about 27, 28% globally as far as corporate taxes are concerned. That's kind of middle of the road. If you had increased it another 5.5%, that would have put us in the top 10% of countries in the world. Again, from a global economic perspective, this would have made us not competitive. And Joe Manchin's been saying all along he wouldn't go above 25%. That goes back to early in the summer, you'll recall. Well, Sinema came out and said 2 weeks ago, no, no increase. I'm sticking with the flat 21%, just like I'm sticking with the top 37% for individual income taxes. I don't want to see any bracket increases. So this was taken out of the framework deal. And but stay tuned. They're going to need some pay-fors for this Build Back Better program, the social justice changes that are coming in. This was a huge revenue raiser that is now out. And whether the Senate can balance what they want to do without this is going to be a real challenge. Tax-free S-Corp conversions. This is actually beneficial to your clients. The ability to, on a tax-free basis, do a liquidation and reincorporation as an LLC and check the box as a partnership. That would have been a good thing, but it's not in the framework bill as of a week ago. Not going to spend a lot of time on that. Qualified S-Corp stock exclusion reduced. Right now, if you're an original investor in stock in a small business for a period of time, 5 years, when you sell that stock, you can eliminate the capital gains. It is an incentive. It's called a 1202. It's an incentive to invest in startups and small businesses. This has trimmed this back. It's not going away, but for many taxpayers, those making AGI over $400,000, or for a lower number for trusts and estates, this is going to be trimmed back to 50% exclusion on or after September 13th, 2021. That's the first time you've seen that date hold. right? Because the capital gains isn't going up, but this September 13th date is holding for this provision so far. October, corporate alternative minimum tax, 15% of minimum tax was added. This was not in the original 2,600 page September 13th House bill. This just came back last week. It's a minimum tax, 15% minimum tax on adjusted financial statement income, a defined term yet to be defined, against large corporations. So if an Amazon shows no taxable income on its tax return, yet it has book income of $2 billion, well, they're going to be hit with a $150 million tax, even though under the law as it stands today, because of accelerated depreciation, perhaps goodwill write-offs, other write-offs, stock option write-offs for executives, huge write-ups like that are legally able to reduce their taxable income down to zero, because they have book income of $2 billion, they're going to pay $150 million with credits going forward for that amount of income if they every year go up and down as a minimum tax would, effective for years beginning after December 21st, 2022, another year out. It was added back in the framework bill. We'll see what happens. This drives accountants crazy, especially auditors and financial accountants, not just tax people, because now this will open up financial statements, GAAP financial statements. I'm sorry, using acronyms. I'm an old accountant. Generally accepted accounting principles. When you read an audit report, that's what they're based on, and it opens that up for more manipulation, right? Well, maybe we want to take a write-off now for book purposes and lower that book income, GAAP income, from $2 billion to $1 billion. So you're going to see a lot of play with this. Excise tax on repurchase of corporate stock. Again, this has been a target for a while, and of the Democratic Party. So they're adding a 1% excise tax on repurchases. Again, it comes out of the PPP program, the IDL program, the different programs that came out of the CARES Act. A lot of the large corporations received government subsidies and then turned around and repurchased their stock, which was criticized. This was added back. That was not in September 13th, but it's been added back. So in the short period of time we have left, and then I'll open up to the last few minutes of questions. What's not in what you just saw? What did I just not talk about? The SALT deduction. I'll talk about that in a minute. It was changed again this morning. It was added back. Capping the value of itemized deductions, the original Biden proposal back in the spring, limiting the value of retirement plan contributions to 26%. They were going to disallow deductions for your IRA, for your 401k, no longer is a deduction, but you're going to get a 26% credit for those. That's not in here. Could it come back? Sure, it could come back. The elimination of step-up in basis on death. We talked a lot about that during the summer. And the tax on unrealized capital gains at death. That's not in here. Could it come back in the Senate? Sure could. The 40% estate and gift tax bracket. Right now we pay a flat 40%. The Biden administration had proposed all along through the summer of raising that to 45%. Bernie Sanders, recall, wanted to bring that up to 65% at a top tax bracket. It continues to stay at 40% today. Like-kind exchanges for real estate, that was going to go away. That's not in here. You can still do 1031 like-kind exchanges on real estate. The billionaires tax that was talked about a few months ago got a lot of press. Billionaires on unrealized gain was going to, I think, hit about 700 billionaires. It's not in here. But remember, Ron Wyden is a senator, and he's chairman of the Finance Committee, and he really likes that one, and he resubmitted a new proposal for that just this past Monday. So it's not in the House bill. So 5 minutes to go. Let's just talk about the November outlook, and let's say November/December outlook, because we are going to go into December. I said it here, first, second, and third. Remember that. The infrastructure bill should pass. Based on everything and all the pundits and signals we're getting from Washington, it could pass today. and it could go to President Biden for his signature, and it goes right into law as soon as he signs it. Not many estate, gift, or income tax provisions in that bill. Then we move on to this, which is the Build Back Better plan bill. $2 trillion social spending bill. If it passes today, if they're able to line up all House representatives today, which Nancy Pelosi has been working hard at for the last, I don't know how many hours. I don't want to say 24 because I know it's a lot more than 24. It's been 2 months. It will pass and go to the Senate to be rewritten. And that's going to take some time. It takes 2 weeks just to go through the parliamentarian's position office to go through all the provisions to make sure they qualify for the 50 vote rule and not the 60 vote rule, that everything falls under the revenue umbrella as far as provisions are concerned. That takes 2 weeks alone, and then we're at Thanksgiving. So mark my words, we're going to go into December on that. If and when the Senate comes up with their own version, and they will, I think they will. I think that's a very high likelihood after a lot of angst and discussion. It goes back to the House. And we all know that some of what Bernie Sanders is proposing with respect to, for example, the SALT deduction, the House won't agree with. So it's going to go back to the House to be rewritten. Now, if the House just passes it without any changes, it goes to the president, becomes law. But I don't know what the odds are of that. And finally, I added this morning. All those retirement plan provisions that you just asked a number of questions about that cause a lot of concern among financial planners, I've heard one opinion yesterday. I'm on the governing council of the American Institute of CPAs, AICPA. We had a webcast yesterday. And it was brought up for the first time. If any of you are aware, the Secure Act 2.0, remember the Secure Act passed at the end of 2019. It's the act that has the 10-year RMD limitation for inherited IRAs. Now you have to take it out within 10 years, among many, many other restrictive provisions. Well, Secure Act 2.0 has been entered into the House. For example, it would raise the RMD age from 72 to 75. Just one example. These retirement plan restrictions that I just talked about could be yanked out once it hits the Senate if they are too controversial, and it could be moved over into Secure Act 2.0, which would separately become a separate bill and perhaps get passed in late 2021. I doubt it, but that's what people thought, or 2022 more likely. Upcoming deadlines. December 3rd, recall that the can has been kicked down the road twice now on the short-term highway funding stopgap, previously extended twice. Now, at first it was set to expire September 30th, which was the government's year end. It got kicked the can down the road to October 31. Now it's been kicked down the road to December 3rd, which happens to be the same date that Congress needs to fund the government to prevent a shutdown. And again, that could be extended as well. And finally, debt ceiling crisis, separate from the 2 bullet points above, could hit in mid-December. So we have other deadlines coming up that are going to put pressure on Congress. So my conclusion, it remains to be seen what's going to be in here. What is voted on today, like I said, I think I've gone through 2,100 pages. Believe me, I didn't read all 2,100, but I read about 60, which was the retirement plan provisions, and to come up with those effective dates. So that will go over to the Senate. It'll be rewritten, and we may then come back to the House of Representatives. Most likely we will. And with that, any final questions? I know I'm running out of time.
Dan, we want to say thank you for going through all of those pages and pages of proposals. Thank you for that.
Mm-hmm.
It is helpful. We're grateful for your presentation. We have a few more questions. The first one is, how can we follow you to continue following these updates and learning more from you?
Well, if you can see me on screen, which most of you can, my screen just shows questions. I put an article up here on my wall. Where's my hand? Okay, right here. I covered I just wrote an article that got published 2 days ago. And this one's called, I have to turn around 7 strategies to maximize your year-end charitable giving. But my lead is 2 paragraphs about what's going on in Washington right now, why charitable giving will become even more important at the end of this year. I need to update my article on the Build Back Better plan. I wrote a 5-page article back in after September 13th. Feel free to email me. I put them up on LinkedIn. This article went on LinkedIn yesterday. And you can follow those articles. I think I've published 12 so far this year, and I usually handle the top planning topics in the area of tax and estate planning and financial planning. So please link me in. Again, I'm Dan Rahill. I also co-lead our family office banking practice at the bank. We also have a focus. I'm a part of a group that just focuses on helping our RIAs. Many of you are IRAs. But there is my email, danrahill@wintrust.com. My cell phone, you can text me, 312-957-5712. I happen to have been born in 1957 in the month of September, so that's where the 957 comes from. Link me in, and I publish articles regularly. Probably I'll put one up per month, and then I have about 30 articles that I've published that are on the LinkedIn posts in the back, the article posts, not the daily posts. So that's one way to follow some of these, and just email me from time to time. And I know you all receive email blasts from all over the place, all the time. And I used to keep a list of 600 or 700 of my closest friends, and when I wrote an article, I email blasted out. I just felt that was too much for people. Maybe not. If somebody wants any of these articles periodically, email me, and I will start a new list, and I'll send it out to just those people who care. But I don't want to spam people. That was my concern.
Perfect. Well, Dan, we really appreciate this wonderful presentation that you've given. We are now at the close of this session, and so again, thank you, Dan. For all of you in attendance, thank you for being here. Once more, you will receive an email at the end of the day to report your attendance and receive your CE. We're going to go ahead and now transition to a 45-minute break until 11 o'clock, and would love for you to also visit our exhibitors, take some time to spend with them. Thank you so much, and we'll see you at the next session.
Thank you.